Sandip Sabharwal, who's joining in on the show. Hi there, Sandip. Good to have you. Let's begin by talking about that tremendous rally that we witnessed within the entire PSU banking space. Now, you can attribute it to the fact that there has been a change in the overall fundamentals with strong credit growth, recoveries, asset quality as well has improved significantly. Do you believe that this run-up is here to stay?
So there are two parts to the PSU Banks rally. One is that after the news of the inclusion of Indian bonds into the bond indices, we saw a rally in government bonds. I think that was a positive fillip. And secondly, it's a part of the overall move in PSUs. If you see how many of the PSUs have moved, so many smaller PSUs have actually almost doubled or more than that during this year. So I think it's more a PSU play than a specific PSU bank play. Longer term, I don't recommend that people should keep on buying PSU banks at higher and higher valuations because I think from this quarter, next quarter onwards, we'll start seeing some uptick in NPAs and a squeeze in margins, which was not there for the last few quarters. So I think some allocation is fine, but I think excessive allocation to PSU banks doesn't make any sense.
Make it tempered allocation if you must to the PSU banking space, but the rally is across PSUs and not just banks. In fact, talking about PSU, Sandeep, defense is one space which we were discussing earlier in the morning as well, that it might be up for another leg of re-rating given the kind of project approvals that have come from DAC as well. Any stock that you like from the defense space that you still think could be bought?
So I think the oldest one, which is the most steady one, Bharat Electronics, I think that's the only one I would think that still offers decent value. Rest of them, at least on the PSU defense sides, the move has been too rapid. And at these valuations, it's tough to buy them. So I think there's no reason so there are two things to it. There's no reason for people who are holding these stocks to sell because there's no logic behind it because even if there is some correction, the old investors can ride it out for the long term. But for people who want to take fresh exposure, I think the runoff has been too swift. So every new order cannot lead to a new re-rating because that is something which is expected that order flows will continue and that's already built into most of these prices.
Okay. Another stock which I think is worth revisiting is Jubilant FoodWorks. Sandeep, Zomato has gone from 50 rupees to 100 rupees and Jubilant FoodWorks, which is in the same business, makes profit. It's a play on demographics, strong cash flows, a decent balance sheet, has done nothing. So if QSRs are doing well and if World Cup is around the corner, do you think this could be a sitting duck stock idea?
So I think, Nico, there are two parts to it. Zomato benefits from the overall growth, so it's agnostic. So it doesn't matter for Zomato which food category, which restaurant, what is doing well, as long as the overall pie is going. So that's very different from what Jubilant is facing in terms of intense competition from Pizza Hut, other pizza chains, as well as their internal issues related to low ROCE expansions. So, one, you are right that sentimentally, as the World Cup is around the corner and there is a general expectation that food ordering will improve, that could be sentimentally positive. But fundamentally, the stock is still very expensive given the kind of earning downgrades we've seen for Jubilant as well as how it's performed relative to many of the other companies like Westlife, Devyani, and a few of the other listed QSR companies.
Okay. I'm going to again go back to PSU banks with Nuresh. Nuresh, the leader is SBI, and in this market comeback in PSUs, SBI is underperforming. UCO Bank, Bank of Maharashtra, the smaller ones are the ones where the action has started. It's like saying the tail has started wagging the dog.
So what has happened in the PSU bank spaces, in the first cycle where we started re-rating was in 2021, which is where SBI went up from 300 all the way to 600 by 2022 end. And in that period, we did not see as much of a outperformance in a lot of these smaller names. And now we've started seeing this outperformance coming up. So if we look at say open up a chart of Bank of India, the stock topped out at 100 in Feb of 2021, went down to 45. Again, started a rally in October 22, went back to 100 levels, then came back to 70. And now now it is back to 105. So essentially, over the last 2 years, the returns are not that great. It's just that the volatility is much higher in a lot of these smaller PSU banks. They saw a correction of almost 30% from the top in 2022 and 30-40% from the top of 2021. So we are coming back and crossing those levels. So that's generally an indication of a new cycle coming in of re-rating. And mind you, most of these names have corrected a lot over the last 10 years. Many of these names, say a Bank of India is available at the same prices where it was in 2005 and even 2004. So a lot of these smaller PSU banks have been major underperformers for the last almost 15 years. So what we are seeing in the near term is a short-term outperformance, and the trend is pretty positive in some of the names. But one has to be careful because the volatility is high, and once they top out, they tend to correct 20-30% as such. So the names which I like the most is something like a PNB, which has given a breakout and it has corrected the most also over the last 15 years. The stock is finally above pre-COVID prices of 65. On dips to 70, that remains up high. Then Bank of Baroda on dips, Can Bank has already moved up in the near term. The rest of the names, UCO, Central Bank, etc., one has to be careful. They've made a short-term move. So overall, be careful here. The risk reward is not great, but yes, the short-term trend could continue.
Right, stay on with us. And which are the pockets that you should look to bet on after this bull charge? Well, we caught up with some top market experts, the likes of Dinshaw Irani as well as Vineet Samre and Anand Shah. Listen in.
Our major themes going forward, and that's where we're very bullish on, is financials and discretionary consumption, and also affordable luxury kind of consumption that we're looking at. Discretionary is what we're looking at, and there again in say aspirational luxury. So obviously hospitality comes in a big way. Pure textiles move in here. There are shoe companies as such which come in, and obviously these are a few sectors that are playing out for us.
Without labeling them as defensive or growth, I would say that bank today makes a lot of more sense, because whatever growth we are talking about in the economy, definitely it has to happen through the banking sector. I keep talking about IT as one of the sectors which I generally have a positive bias towards, because of a simple fact that this is a very strong cash generating sector. And more importantly, this is a sector which also distributes a large part of the profit back to the shareholders. And hence, from let's say dividend yield or cash flow yield perspective, this is one of the better sectors to look at.
While the Indian consumer story is not lost to anybody, Indian consumer has been doing well for last couple of decades. You have a large middle class population where the dependency ratio is falling, per capita income is rising. So obviously Indian consumer story is not going anywhere.
Okay, so that's the take coming in. The Indian consumer story is not going anywhere. Just wanted to discuss a couple of other stocks as well. Kunal, what's your view on NCC? The stock will be in focus today on account of that arbitration claim that they have got. Of course, it's lower than what they were expecting, but at least they're getting almost 200 crore rupees. And Bajaj Auto, that was that stellar outperformer on Friday with that 6-7% move. Do you expect a reversal today, or the momentum will continue?
I think Bajaj Auto could be a case of a breakout. My sense is that the stock has done pretty well for itself, and when you look at this consistently from start of 2023, the stock which is almost at 3,500 showed patterns of higher highs and higher lows consistently, which means that it's an indicative of a very strong trend coming up for Bajaj Auto. And within the process of a trend, when the stock consolidates for a extended period of time, we expect the stock to get into a sudden breakout, to just convert the mean reversion of the time-wise consolidation and going to a breakout. We saw that happening for Bajaj Auto on previous week Friday, so I'm expecting the stock to get into a follow-through up move. More importantly, this pattern of higher highs and higher lows should continue for the stock. NCC could be a classic case because the stock has already corrected. I think if I'm not wrong, 175 was the previous high for NCC very recently, and the stock is back towards that 145 mark. So it's already baked in a correction of 15-17% recently for NCC. I would probably expect that maybe it's coming very close to a bottom out formation, and I would actually go for a contra buy on NCC in case if the stock dips marginally today.
All right, let's get a move on then and put the spotlight on the stock on the editor's radar. Today, it's AU Small Finance Bank. And Nikunj, if we map out the charts on a year-to-date basis, it has been a bit of an underperformer, but lots of triggers down the line.
See, I think independently the franchise has done well for itself. Loan growth of 25% plus, really no NPA problem whatsoever. And also in terms of risk management, what they've done, I guess they've got a very neat franchise in terms of the technology they've built up. I mean, CASA was a challenge for them, but I think in this war of liability, AU has done rather well for themselves. But I've got a very interesting Nomura note in my hand where there's again a media report that AU is looking at acquiring a small finance bank in the south. Yeah. And if that goes through, what could be the impact of that? Now, if you assume that AU is going to be going ahead with one acquisition, the first big acquisitions ever since they've gone public, in the near term, it clearly means that AU is looking at diversifying outside the cohort, which is the western and the northern region, to the south region. I think they need that growth because they have to expand. Up until now, otherwise they would be known as a very regional player. So in the near term, if the acquisition goes through, of course it will have impact on the return ratios and the ROAs, but I think in the medium term, that is where AU needs to build. They have to come out of the strong cluster, so to speak, and focus on the other areas. I guess what I like about AU, Avan, is the fact that they build a franchise which is high growth, but very low in terms of NPA problems. They are not a universal bank, but I guess the book is so solid that the fee-based income is also coming decent. Now it's expensive. The problem with this franchise, it's expensive, and if they go and acquire another small finance bank in the near term, it could lead to dilution about 4 to 5%. So in the near term, it could be pressure, but I guess 18 months, 24 months from now, the benefits of this kind of an acquisition would be seen through, because if AU does not grow, they would pretty much be restricting themselves to being a regional player with very little presence in South.
Okay, and this could be a key trigger as well, expanding their geographical presence. So that's AU Small Finance on the radar, Anisha. Okay, so that's about the AU Small Finance Bank and the editor's take on that. But let's also take the view coming in from Sandip on that. Sandip, AU Small Finance Bank, as Savan was also saying, it's been underperforming, and Nikunj talking about how it could be a bit of a re-rating candidate as well, given the acquisition might happen.
I'm not a great fan of M&As leading to re-rating, especially when markets are so high. So I think that's something we need to watch out for. I think at one point of time after interest rate hike cycle and after interest rates have remained high for some time, we need to be more cautious about financials which are trying to grow very aggressively and much above the market growth rate, rather than trying to become bullish about them, because aggressive growth at high interest rates, as has been shown in all previous cycles, has led to balance sheet stress. So I would be cautious on many of these smaller banks which are trying, or NBFC which are trying to grow very aggressively at these points of time, and where their CASA franchise is also not as great as many of the larger banks.
Okay. Let's look at metal stocks, and that's where I guess we've debated that China on one side slowing down, US on the other hand picking up. Metal stocks in general, I guess they've been both hot and cold, neither here, neither there. Sandip, this is one space where traders have historically looked at the trend. What is the trend in metals according to you?
I think next 5-year trend, if you ask me, is metals are going to go nowhere, because China still is 50 to 60% consumption of most large industrial metals, and it's going to a deep stress slowdown, especially on the fixed capital side, where many of these commodities will suffer. The counterpoint could be that decarbonization-led capacity shutdowns could balance out some of these demand concerns. How that plays out is something we'll need to see. But one, there's going to be no super cycle to play. And secondly, I think there'll be better sectors to play rather than metals.
Okay.
But, any thoughts on the Tata Steel deal specifically, if you have gone through it?
That's a positive, because it was in pending for a long time, and finally it will become, as per the management statements, it will make those entire operations viable from being completely unviable. So I think incrementally that's a positive aspect. steel prices incrementally have also moved up. Stocks are subdued. So I think these are underowned stocks now. So small positives can create moves, but these moves, I think, will not be very substantial. So I think 10-20% move in metals is the best we can hope for.
All right, let's stay on with us. Let's hear out some top fundamental stock ideas. We spoke with Sanjeev Bhasin and let's find out what he's recommending.
A long time I have not seen L&T hit new highs. So has NTPC. So has Coal India, which has surprised, 220, 217 almost a couple of months. And it's telling you industrials, power, hydrocarbon, engineering, electrical, this space is rocking. And there is no two ways. Cummins, Thermax, ABB, Siemens, you name it. L&T takes the cake. Now their order book is so large and the execution is, always questionable for the PSUs, but not for a private company like L&T. And now they're talking of double-digit margins. So I think power, infrastructure, and the likes of L&T, Coal India, NTPC, and I'll give you a couple of dark horses on the mid caps, which I think can be equivalent to the return, which if you are looking for that. But L&T overweight, NTPC and ONG, Coal India are also three overweight stocks for us. Coal India which was discarded because of thermal and other issues, is now revving up. And I think that this whole Ukraine-Russian crisis has actually turned out to be a blessing for them. You see the dispatch numbers. It's the third largest producer of coal in the world. And I think it is just getting its recognition.
If we look at the entire cap goods as a place, so I think my preference would be more on the terms of the private players, rather than BHEL. So maybe at this price, I would avoid BHEL. Maybe at correction, I would look at it for a longer term play. But if I have to look at something like Siemens or something like ABB, though the valuations are expensive, but I feel that there will be a safety and the risk versus reward would be quite favorable from here. So I think again here the returns could be also a very moderate kind of a return. The stock has done well, so I think these are only 12-15% compounder from here. So that is what it looks like. So my sense is I think again Siemens and ABB remains the top bets in that entire sector.
Sandeep, the other theme is power. Merchant power, power transmission, power utility, power finances like PFC, REC. Unlike defense and railways, power is more like a short to medium term theme, where there is power shortage in the short term. Supply is less and demand is more. What is the best way to capitalize on this entire, power cycle per se?
So I think I like to buy the equipment companies, the transmission companies, the companies which build the plants, etc., rather than the power generators, because I think in India we've seen in various cycles that the power generators tend to get their margins squeezed as politics takes over. Power distribution companies typically have been loss making, so their dues keep on growing. Now, something is changing out there with the entire smart metering, prepaid metering aspects. So I think that would reduce the risk of the overall sector. But buying power generators, which is typically a very low ROC business, you see the return on capital of most of the power generating companies in single digits. And many of these stocks have just zoomed up. Like even the smaller companies out here have zoomed up twice, etc. Many of the PSU companies actually are some of them making losses, have doubled this year. So I think there is need for caution out there, but the investment cycle is strong. So whoever the equipment suppliers are the lowest risk players out here, and that's what people should play.
All right. What's the take then, Sandeep, when it comes to the entire chemical space, owing to the fact that the crop prices have been under a bit of pressure and experts are saying that the rising input costs could impact farm profitability. What's your sense?
So you're asking about agrochemicals, right?
Yeah.
Yeah, so the agrochemical cycle is going through a stress, obviously, in both domestically and globally. And the main issue is high inventories in the system. So the high inventories in the system will lead to lower primary sales from the producers into the market. So I think that, and it typically it should take at least 2 quarters for those inventory issues to get sorted out, even if the market revives. So I don't think there's any great story. Many of these stocks have got sold off a lot, and to that extent, there's a buying coming in because of that, because these stocks have got sold off a lot. But in the near term, I don't think there's any revival happening.
Okay, no revival as far as the agrochem is concerned. But Naresh, a chart check going for a lot of these sugar names, which had seen quite a bit of rally last week, and also Vodafone Idea. We understand the reason now why that stock was surging, because they've managed to prepay almost 1700 crores.
So, in terms of sugars, I'll start off with the main one, which is Balrampur Chini. The stock finally broke out above the 420, 430 mark. The volatility remains because the stock keeps going into derivative band. But technically, the breakout is done above 420, 430 last 1.5 year. Every time it would come to 420, flipped back to 360, 380 levels. Finally, the breakout is done here. Should ideally go towards 520 over a period of time. A lot of other names have already broken out and made larger moves, but there would still be an opportunity in a Dhanpur sugar, which has broken out about 290, 300 levels on dips. Dhanpur remains the next bet. The other names like Dalmia, Awadh, Magad, etc. have already moved up quite a bit. So that looks, as a sector, one needs to wait for the smaller names for dips, but Balrampur and Dhanpur look interesting. In terms of Vodafone Idea, what is interesting is the fact that the volumes in this move has been very good. So from the move of 8, 8.5 to almost 11.5, 12, the volumes have been almost 2x, 3x the general volumes. If we go back almost a year, 10 was the high in 2022, roughly in the end of it. So we've crossed about those 10 levels, and the next major price point is now closer to that 14 mark, which is where it saw a last major gap down from. So I would expect 13.5, 14 to be a resistance for the near term and a target price also. And one could keep a trailing stop loss at 11 here.
Sandeep, when I say, I'm saying this with a lot of sincerity, and that is a reality, which is that now and then, earlier it was now and then, now it is regular. There is always 1 or 2 WhatsApp rumors every week about the future of Vodafone. What should one do? I mean, just avoid Vodafone, or there is something which could happen in Vodafone, and what people are talking about it being a multi-bagger, it may just happen.
I think I'll go with the first option. Avoid it. Don't even track its stock price. Don't even look at it. It's a bankrupt company.
Let's understand the fundamentals here, and let's break it down for our viewers. I just want to make this bite, even out on our digital platforms, that why should one avoid looking at Vodafone completely and totally, even for trading and investing? Sandeep.
It's a bankrupt company. It has no value left for equity shareholders. The kind of debt it has and the cash flows it is generating and can potentially generate will remain negative for years to come. There is no revival inside. They are losing market share, and and this is a very high operating leverage business. Telecom people need to understand, because once you have set the capacities, every incremental subscriber you get, you make money on that. But every incremental subscriber you're losing, then your losses get magnified. So I think the fundamentals of it, entire aspects of Vodafone Idea are so negative that it cannot generate any return for its shareholders. Now, you want to play momentum, you want to play it just because everything else has moved up and it's available at 10 rupees, you can do it. But then once you start riding the tiger, then the tiger decides when you get off. You don't decide it.
Which tiger have you been riding, my friend, that you're giving this kind of an analogy?
I ride a few tigers, but then I try to jump off early.
I think what everybody is riding right now is that bull run that we are witnessing across the board, record high levels and all of that. So not tiger perhaps, but bulls definitely.
Yep. We actually had a show called Riding the Bull, and then the bear market came here to take the show off air. But I think it's time to...
But then you could also ride the bear. We could have just changed the name of the animal perhaps.
I was not sure whether it's a real bull bear market or not. So in India, you don't have a bear market. See, you have to realize that India, I always say this, that never go short on India. The decade belongs to us, right? You can talk about incremental things going here and there. And the way to make real, and Sandeep, and we've really spoken about it, I give credit to Sandeep, I've learned it from him, that you buy the bad news in the world when it comes to India. So the bad news in the world will have an impact on Indian stocks, and that's the time you buy India. So whether it is 2008 or 2020, 2021, so when there is bad macro sell-off in the world, you buy India. I think Patricia must have got the data wrong, that when do bull markets have peaked? And Sandeep, I'll just come to you. Let me just read off the data here. When a bull market peaked,
you want to take a minute?
We'll take a bit of a break, but it's interesting really to get a Nikunj's take on this, because he's talking about, the previous times when we have seen these events that have really had very big ramifications. And Nikunj, if we were to start off with 2008, 2009, the global financial crisis.
India in a bear market, my throat choked. It was natural reaction. It was a natural reaction.
Say those words.
Yeah.
So Sandeep, I'm just moving away from defense and railways, but here's the data, that the bear markets, whenever they've happened, it's largely because of global macro.
Yeah. So all big corrections happen due to global macros. So we cannot ignore global macros. So that's the most important point out of this data. So when people say that everything in India is so good, I agree. Everything in India is good. But then when there are periods of time when global macros or global aspects turn adverse, and at that time we need to turn cautious. So I think that's the biggest takeaway I would say from this data.
Okay, fair enough. Meantime, media stocks, and they've really been buzzing. And Kunal, I just wanted to get in your take on some of these names. For instance, like a DB Corp, the last 6 months return, of course, it's been like 150%. Z Entertainment, yes, there have been lots of contentious issues with respect to the merger. Nonetheless, in the last 6 months, the stock has gained about 30% or so. And then we've seen a slew of hits coming in from the multiplex companies. So that has kept that, space very active and alive. And even something like Sun TV has gained close to 40% in the last 6 months or so. What's looking good here?
Yeah, I think, DB Corp, I don't track very closely, but yes, even that stock has done pretty well. I think from 95, 97, just about 2 or 3 years back, the stock is at 200 plus levels. So been an exceptional return generator. And I think it's been more of a straight line rise for DB Corp. But the two charts within the media space, which I do track very closely, and the ones which have given breakout, one of course is Sun TV, because I think that's a stock which had been a huge underperformer. And we're talking of 3-4 years of underperformance for Sun TV, where the stock corrected, consolidated for an extended period of more than 1.5 to 2 years. And then all of a sudden in the last 2 or 3 months, we've seen a major breakout coming back for Sun TV. The stock coming close to that 600 mark, which is a major breakout point for Sun TV. And I think the last time in terms of the indicators, etc., when the stock was positioned, the stock had given returns of more than 50% in the span of the next 6 months to 1 year post such kind of a breakout. So I would probably expect something similar going on for Sun TV this time around, and hopefully in the next 1 or 2 years the stock can deliver such kind of a strong returns. Z Entertainment, the stock has been into a lot of news flow, so very difficult to give a strong technical view, but yes, the momentum has played out quite well for Z Entertainment so far, and we can expect that this time the momentum can take the stock back towards at least 285 to 300 zone.
So momentum has been strong in some of these media names, but Sandeep, it's FMCG which has been massively underperforming. I mean, if you look at the last week data as well, Nifty FMCG was the biggest loser, and a lot of these names, right from Asian Paints, call it the crude impact or the monsoon and demand impact. They haven't been doing much. Is it the time to buy these stocks, or do you think there'll be more lucrative levels coming which will give you the opportunity to add these names?
So consumption has been suffering as a result of high inflation for the last couple of years, and that's got reflected in these stock prices as they were relatively overowned, and then other stock sectors started to do well. Now, some stocks in this sector are providing opportunities. So wherever these stocks correct 20% from the top, we take a look. I think Asian Paints has its own issues going because of entry of Grasim into the paints sector, growing competitive intensity, and so to that extent it's a different story, but possibly something like Dabur, Godrej Consumer, or Britannia, I think these are the stocks on the lookout we can buy at lower levels.
Okay, now this entire urban consumption theme is the standout theme for this year. Whether it is Ethios, Sula, Bikaji, Varun Beverages, well, not urban consumption, but yeah, the stock's done very well for itself. So Ethios this year is up 69%. Sula, right from the word go, the IPO was not that great and it has just managed to hit out of the park. And then you got Bikaji also, which has done rather well for itself. Sandeep, anything in the new IPO which looks attractive in terms of a business, becomes a buy at a lower level, is expensive, but when the market declines, is a great business to buy?
I would say that uh, Dr. Bector's is something which I looked at where we took small exposure, we couldn't increase because the stock just zoomed up. So, like you said in your comments, stocks is expensive and we should look at it on a reasonable correction. So, I think that's one company whose business model I like.
Talking about the IPOs, of course, you talked about the ones which listed in the last 2 to 3 years, but a lot of IPO action lined up this week as well. Of course, the IPO that opened for subscription issue, names like Sai Silks, Manoj Vaibhav Gems and Jewels, and then IPO which are closing in as well. There's Sami Hotels, Zaggle Prepaid, even Yatra Online. Sandeep, any name that you have tracked and liked?
Put IPOs on the sideline. I think there's the frenzy on the IPO side is so crazy. I don't know. Like one that doesn't make any sense. I don't know what allocations we'll get. Nothing. And secondly, I think the frenzy is so great that I think this kind of frenzy doesn't lead to. So I think the end is not good. I would say so. People should be very cautious putting in big money into IPOs.
Certainly a very extensive list, and it's been a buzz at the primary markets. But Sandeep, does that thought extend even to the listed fintech players?
Yeah. So I think on the listed fintech players also we've seen a substantial rally. Now, a large part of that has been driven by management commentary on profitability about the future and changing business models. Some of it is real, some of it is something which will be tough to achieve. So, I am not a buyer in any of them at this stage.
Okay, Sandeep, on that note, we'll let you go. Appreciate you joining us.